guys. Yeah, so as we talked about yesterday, the euro weakness is a little bit systemic here, and it's coming through the drop in German bond yields, which are continuing to get worse. At the same time, you're getting overtures that John Taylor has been, well recommended and well liked by Trump, and he's gaining in popularity as a potentially new Fed chief. Now, this Fed chief game that we're playing at the moment is pretty important for day-to-day movements in the US dollar. The more hawkish the member, the stronger the US dollar, and you're definitely getting a lot of strength in the US dollar on the sort of support that John Taylor is getting from the White House and the rumors out there. Now, what this means, given the situation, is that the euro buyers, of which I was one multiple times, have been caught on the wrong side here, and that leads to bigger than usual clean outs usually. Now, the story of the euro falling with the lower for longer interest rates does have a base though. So the range trading game still plays, but I don't want to be entering until we get into that 116 lower 116 levels. And I'll be buying around 116.20, 116.30 with a stop below 115, and the target is 120 on after that. ECB sort of support is not there right now. The ECB game, where they're talking about cutting the amount of QE but extending QE all the way to 2019, has a dramatic effect on German bond yields. The German bond yield 2-year difference between US and Germany is getting larger and larger every day. That puts downward pressure on the euro. So as regardless of what you expect to happen or think should happen, the euro can definitely go lower here, and the positioning on the euro is quite long. So I'm not like I'm a US dollar bull, super bull. It's just that the euro positioning creates a situation where the euro can get cleaned out. After that clean out, I think it's it's fair value here, right? Given this change in ECB sentiment, but the positioning is too long. So a clean out, then we'll buy that dip. That's a very high probability trade, in my opinion, that we can get that dip lower. The US dollar buying, obviously, if John Taylor gets the nod though, then this could get a little bit aggressive, and might even break 115 in the short term if that's the case. The way that I've flipped into here with stocks remaining strong, I've flipped into long dollar yen. Dollar yen's been underperforming most majors in terms of the US dollar strength. And since, it did underperform the immediate rally, but it's been underperforming in the last couple of weeks. The yields have ticked higher to the point where I think we're undervalued here, so I'm liking the dollar yen long here. I like it for a run at 113 and above. And we'll see how it plays out in the coming days, but that underpin of support from the Fed and the yields should be enough to get past that 113 level. Obviously, if Abe wins, that's going to be that next catalyst that gets us to 114.50, and what happens there is interesting. There's ways that dollar yen can go all the way higher towards that 118 level, but first of all, we've got to get right here that 113. The biggest concern I have with being long dollar yen, yen being a safe haven, is that stocks are so overbought that at some point you're going to have a correction. And if you're stuck buying dollar yen and whatever causes a correction, missiles, tests, or Iran, nuclear deal scrapped, whatever causes the correction in the Dow Jones will hurt the dollar yen. So this is a trade you need to nurture, need to watch after, look at it closely, and not leave. Make sure that you're noticing what the story is in the stock market, and also who gets the Fed chief nod. There's still Fed chief potentials that are very bad for the US dollar, right? Yellen being one of them. But at the moment anyway, I like the fact that the market's caught a little short US dollars and mainly via the euro, and that we've got a little bit of room to move here. And until stocks fall, you can't be too worried. So while stocks are strong, I'm buying dollar yen here. Euro yen I'm not really happy with, because dollar yen's not moving at the same pace that the euro is falling, that's for sure. So euro yen trade's a little bit underwater here. Not too worried about it. I think dollar yen will speed up its rally soon enough, but yeah, the euro is sick and is likely to go lower. We got Carney speaking in a couple of minutes. We're going to flip across onto that. Just quickly before we get to Carney, though, I want to show you the guy who's holding all the power. I know a lot of you trade Aussie Kiwi. I've seen you guys talk about it the last couple of days. This is the guy holding all the power in New Zealand right now. So just quickly.
Know that we've already got the agreement rather than having to go away and write it again. That being the case, the board is starting to wind its way home, and we're going to press on and try and bring the matter to finality as fast as we possibly can.
Basically, he hasn't made a decision yet.
We can't answer too many questions of a confidential nature, but we're going to try and make sure the process is, now that we know we can get the thing completed as fast as possible, that it is completed as fast as possible.
Has the board come to a consensus? The board and top has come to a consensus then?
No.
So there's still some
Well,
more
they've come to a consensus on policy work, as far as we can take it, with some outstanding matters yet. But on the other issues, that is to be decided in discussions with the leader of, no doubt, the two parties. And we can't make a decision as a party until we've had those discussions.
So proposal now to take to both National and Labour? Have you got a proposal now to take to both?
Alright, sorry, you're jumping across to Carney now.
But you're
So they're basically no deal there.
As a healthy focus on price stability became a somewhat dangerous distraction, a distraction away from issues of financial stability. So,
before we listen to him, very important that you understand that Carney and CPI is a secondary feature. The biggest feature is what's going on with the Brexit negotiations. We talked about the dinner last night with May. There was no headlines afterwards. That surprised me. That's negative. There should have been some progress made. There hasn't been any progress made. So, you know, basically how it works with Brexit negotiation is no deal down, pound small, no deal down, pound small, deal huge up, right? So that's the situation with the pound. At some point there'll be a huge rally here if they get the deal. I think they will get the deal, so the lower it gets, the more attracted I am to buying it, either via pound yen or dollar yen or selling euro pound. Either way, if you expect the rational minds to get a deal sorted, then you should be looking to buy the pound at some point. It might be a little early right now.
the reforms that brought in the other responsibilities.
Get to the latest.
We are not the determinants of long-run prosperity in the United Kingdom. We provide some of the important foundations for that, but the key determinants, certainly from a policy perspective, are determined by yourselves and your colleagues in Parliament.
I wanted to turn to look at inflation now, which obviously is in the news this morning. You talked in your opening remarks in September, you said high inflation hurts the least well-off in society the most. It distorts price signals, inhibits investment and ultimately damages the economy's productive capacity. But you went on to say the deflation imperils growth and employment and in the extreme leads to financial ruin and economic collapse. Now this morning, since the committee started, we've obviously had the latest September CPI inflation figure, which has reached 3%. So that does mean you're now 0.1% away from having to write to the Chancellor to explain the deviation from the target, and that will be your 9th letter for target breaches. You have to write it in the future. So do you think the bank is doing enough?
Oh, he loves to talk, Big River. He loves to talk, mate.
To keep inflation to target. Do you think you'll be writing another letter soon, and if so, what will you be saying in that letter?
Can you guys hear this? I know I increased the volume previously on the last guy. It seemed like that improved it.
Well, the first thing,
Get to the latest.
potentially above the 3% level. I think we would take a step back and look at why previous letters have been written since my time in the committee, and recognize the very good decisions made by the MPC prior to my arrival. In other words, there are lags, as you know, in monetary policy, so the outcomes, at least in the first year or so, largely determined by previous actions. You know, the principal reasons behind inflation being very low initially in the run-up to in 2014-2015 was very strong run-up in sterling, and very low the level effects on a variety of energy prices which flowed through. So these are shocks that the bank can choose to look through, and it has to justify why it would look through, and the justifications, and we can go into them if you want, are detailed in this, not just in the inflation report, but in the letters that were written to the Chancellor. The inflation rising potentially above the 3% level in coming months is something that we have anticipated. We had signaled, in fact, prior to the referendum, that we felt that the event of the vote to leave, one of the adjustment mechanisms would be through sterling. And this is a quote, we expected sterling to fall sharply. It did. That passes through to prices. In fact, the UK has one of the highest degrees of exchange rate pass-through to consumer prices amongst the advanced economies, in part because it's a very open economy, but there are other reasons behind it. And as a consequence, we faced a trade-off recently. There's not much monetary policy can do about that. But what we have to look at is inflation and output 18, 24, 36 months out. And that's where we focus our attention, because monetary policy can definitely affect nominal variables and real variables, in other words, jobs and growth, at that horizon. And that's the trade-off we're looking at as a committee in judging what's the right stance of policy going forward.
We're going to go on. I know colleagues are going to have detailed questions on monetary policy, so I won't go on too long on this, but you talked about inflation peaking in October, and others have said the same thing. What is it at the moment that leads you to think that October may be a peak and then we might see a reduction towards the end of the year, or is it possible to say that yet? Well,
I mean, we will have an updated forecast at the first week of November, so we'll give our updated thinking. We're just starting that process now. But the principal reason is because the main reason, in fact, the sole reason why inflation has gone up as much as it has been the depreciation of sterling. And from past history, past experience, we have a sense of the time path of that pass-through into inflation. And then once you roll forward from the initial big depreciation, you have a so-called level effect. Now, the point I do want to make, and I'll finish on this, which is that in general, if you think about pass-through in the United Kingdom of an exchange rate move, think broad brush, you get 40% of the move in the first year, 40% in the second, and 20% in the third. And that last bit is relevant because if you have a very big move in the currency, which is what we've had, is you still have an effect out on year 3. In other words, something that's pushing up. And in previous forecasts, including the August forecast, it has been keeping inflation above target even out at year 3.
Thank you. Before we move on, I wanted just to ask you about a story that appeared in the front page of the Telegraph, the business section, yesterday, about the ONS change on their I think they were looking, they were redoing their numbers on the UK's international investment position. And I just wondered whether the ONS's revision to the net international investment position had affected the bank's analysis of the economy. I think you previously said the UK is relying on the kindness of strangers in reference to our current account and international investment deficits, but this rather dramatic change in the ONS's numbers, you know, affects perhaps how kind strangers have been or continue to be.
Right. We had expected that the current account, which previously was 3.4% deficit, we had expected that it would be revised up. So directionally, we expected something. We obviously, you know, we're not right on top of the numbers as the ONS. That's the ONS's job. So directionally expected it. Current account moving up to 4.5% is consistent with what the FBC's previously expressed concerns about some of the risks around the current account deficit. I would make one point, though, and this is in the realm of financial policy, as financial stability as opposed to monetary policy, which is that if you look at the UK's net international investment position, so the stock as opposed to the flow, it is actually quite healthy. We do a mark-to-market, as helped by the ONS, a mark-to-market calculation of that net international investment position, and it is, even on the revised figures, on the order of 70% of GDP. And that, in part, is in part helped by the fact that the structure of the liabilities, the UK owes a lot in sterling and owns a lot in foreign currency assets, and a lot of what
the Four Corners story was trying to say, which you quoted, was that I was evading tax. I have not been evading tax, and I am not evading tax. I pay what I am required to pay. Now, what people don't understand is that there are businesses outside of Australia which have never been historically taxed in Australia. They are nothing to do with Australia. They are businesses that I own in other countries, in the United States of America. Why Australia believes it's entitled to tax that company is beyond my comprehension, but they do. But that has only started from this year.
What the Four Corners program suggested was not that you were evading tax at all, that would have been libellous, but that you were minimising tax.
There's nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax.
And that you were doing so in ways that were contrary to the spirit of the law.
Oh. Well, I just got through telling you what I thought about that. And what you're saying is exactly what the Four Corners program says. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you're not spending it that well that we should be donating extra.
it owes, not all of it, but a lot of what it owes is low-yielding gilts, and then a lot of what its judgment about what Brexit will mean for a period of time. I'm not making a personal judgment about the fullness of time, but for a period of time, to real incomes in this country and relative real incomes, UK versus rest of world. And in relative terms, the market's judgment is that real incomes would be lower than they otherwise would be. So that is a real factor that's driven the exchange rate. Now, the bank, from a monetary policy perspective, is faced with what is termed under the remit as an exceptional circumstance. You have a fundamental change with the trading relationship with our largest trading partner, prospective other changes which will come because of that, in other words, other reforms domestically and other trade deals with other partners around the world, for those prospective changes. But you have that fundamental real shock, which is leading to inflation going to be above target for a period of time, protracted period of time. And the question that's faced with us is, do we support adjustment in the economy during that period of time? And the judgment of the committee, unanimous judgment of the committee, was yes. And we had the August package, which has supported the economy in the last 14 months.
But you talk about the fundamental shock. I mean, in good times we should prepare for bad, and I would put it to you that at 0.25% bank rate, we haven't got much left in the armoury, and by moving interest rates up in line with inflation, broadly matching inflation, we would have, for the next recession when it should come, or the next financial shock when it should come, we would have more flexibility in being able to manage the situation. At the moment, we've got very little left. I'm
afraid we're 0 for 2 on agreement, because the path of policy is designed to achieve a sustainable return of inflation to target. We, in those circumstances, for the last 14 months, up to and including our last decision in September, the view of the committee was that the stance has been appropriate. Monetary policy is stimulative, as you know, at this time. It is the only macro policy that is stimulative. Fiscal policy is still restrictive. And there are a variety of headwinds going against this economy. Now, the judgment has to be about balancing that trade-off. When do we
What we're going to do is, I don't want to watch that because that's ridiculous. And we've listened to Carney talk for years, and it doesn't really impact the market. So what we're going to look at is the more important story right now, and we're just going to keep an eye on the pound. If the pound goes berserk, I'll keep it on an off channel here. We'll jump back to him, yeah. But at the moment, the pound's moving 5 pips so far since his speech. So it's not the most important thing that we need to be covering here. Time is valuable for everyone, and I just want to go over what's the key thing. So we said we're going to look at this tomorrow, right? We're going to look at who's the Fed chair, and you know, the Fed chair is supposed to be announced, you know, within the next month, but probably within the next 2 weeks, probably by the early November. It's a huge thing, right? The game changes a lot. Now, this was written before John Taylor got the positive endorsements, okay, from the White House. Now, so he was 11% before he did, and you know, Powell was #1 because he got the same endorsements, blah blah blah. Basically, this is what's important, right? This is what's important. What happens if John Taylor, with his rule-based monetary policy, becomes the Fed chief? You know, Taylor wrote the Taylor rule. Alright, now, you know, he's all about what to do if inflation goes up, if employment's strong, blah blah blah. The initial reaction is just on him getting a higher chance of getting the Fed was a strong reaction in the US dollar. Alright, now the US dollar, mostly if you want to see how the US dollar moves when we're talking about bond market moves, then you look at dollar yen most of the time, and the dollar yen shot higher. Okay, and the main reason that we're long dollar yen is because of this story and the fact that the euro is a little weak. So what does it mean? So the yield, the bear steepen, curve shift up, long end risk due to quick QE unwind, which is good. Equity markets is negative. We didn't see that yesterday. I mean, literally the equity markets are new to everything, so let's not read too much into that. At some point there's going to be some selling, but we haven't got there yet. And US dollar sharply higher. So the biggest, you know, change in the US dollar comes probably from John Taylor getting the job, right? And that's where you know, you potentially get those huge rate hikes next year. You get a second big US dollar rally, and you get the market on the wrong side of you know, the euro, maybe the pound, definitely the Aussie dollar, definitely the Kiwi dollar, and you know, big moves lower. Especially if he goes through with what he sort of on paper will do. Okay. Now he's not the #1 right now. He's not the #1 better. Let's have a look at the, I think it's called Predicted. Predicted. You can check what the latest odds are. Are you saying, Kitchi, that you do not like the jackhammer in the back? I love the jackhammer in the back. Do you want me to turn that shit off? Alright. Let's see if I can close all the outside sound. So what you want to be looking here is markets, US Fed chair. So Taylor jumped a lot last night to the second running. Powell's still number one. If that keeps on going higher, which is just basically the only way we have the views of it, it's likely that the US dollar gets stronger. Right now, Powell is almost the opposite, right? You know, it's not. I mean, it's still. They say mildly US dollar positive because you get certainty, but I think at the end of the day, it's still basically, Powell and Yan are the same. You know, you get the ability that the Fed's going to be untransparent, and you get the chance that he delays. He'd be basically another Yellen by another name. All right, now just checking the pound. No, not much movement there. So this is really what we got to keep an eye on here. Keep an eye on the changes to the monetary policy chances, and from that we can play a little bit of intraday volatility. All right, so. I like the fact that we're getting that. Probably, I mean, obviously it's easier to just wait until we get the announcement, but this is affecting the euro trade. It's affecting, definitely the Aussie dollar trade. Aussie dollar all of a sudden rolled into weakness. US dollar strength is basically, the only thing moving. Strength or weakness in the US dollar is the only thing moving the Aussie dollar at the moment. On Thursday you do get the unemployment numbers, but that's the main thing. This range has already been broken on the euro. The ECB talk is basically the main. I mean, we talked about this yesterday. The ECB remaining and today, the ECB remaining lower for longer is ultra negative.
We want to get inflation, which go everything from compression to rollover to exercise of options, substitution of collateral, big things in the mechanics of derivative world. It is pretty clear that those contracts don't continue to be valid, if I can put it that way.
Yeah.
They're valid if nothing changes, if they just run off, but if anything changes, and something always changes, then they wouldn't be. That can only be solved by both sides. There's not, it's something unilaterally the UK can do to solve it, nor something unilateral that the EU 27 can do to solve it. That's an issue, and we have surfaced that. We've done that publicly in the last few months, in part because we've been working to find other solutions which don't work. The market can't quote novate all these contracts in time, and so that's an area. I'm using that as an important example. That's an area where we do have to work on it, and I think that had been underappreciated in the comment.
So you would like, presumably, the go-ahead from whoever I mean, because you've done this before, right? When you were governor of the Central Bank of Canada, you agreed a supervisory arrangement with the UK to allow clearing of Canadian dollars here, right? Yeah. So you would like to get the go-ahead from the UK government and whoever has to push the green button in Europe to start those conversations to come up with that regulatory framework.
We would like to get the go-ahead, or to have the right interlocutors from the UK government to have the go-ahead to have those discussions supported by us in technical sense. I think it's clear the UK government would like to have the go-ahead to have those discussions as well. But I think
presumably you're lobbying when you go over to your meetings with the ECB Council, you're lobbying for them to put pressure on.
Yeah, I mean, I'm not sure central bankers lobby, but we have full and frank, objective, evidence-based discussions.
Yeah, okay.
And so I'm bringing more evidence to the table.
All right, we'll take that. We'll take that as code. Say the EU decides to go for what I guess you would characterise as this kind of self-harming option, adding this additional cost to their own industries, they go for this location policy, they find some way to, in their own legal terms, to discriminate against London, but let New York carry on, all the rest of it. What is the stop to international counterparties deciding to clear whatever currencies they want in London?
Well, it's difficult to design. Certainly, if I'm a UK-based bank, whether it's a UK headquartered bank or a foreign bank that has its operations, its subsidiary in London or branch in London for that matter, if it's trading with a Japanese bank, a Canadian bank, an American bank, and it wants to clear euros in London, it can clear euros in London. So
and what proportion?
So sort of policy of currency nationalism is not goes to that. The proportion of it's a low teen proportion in terms of European counterparty to European counterparty of the overall bucket that is of swaps cleared in London. So it's forgive me, I can write back. It's 12 or 14%. It's referenced in the speech, but from memory, for the sake of argument, let's say 14%. Just so I'm giving a high estimate, which means that obviously 86% of everything else is there, which is why the economics of what's left, it's not quite as good, but it's still pretty compelling.
Okay.
And as you know, but just for the record, what the economics are driven, the more collateral you have and the more diversification you have by way of currency and others, the better the economics are in terms of centrally cleared.
So what you're saying is that if a European-based institution attempts to clear euros in London, so the EU would have to find some way to punish that institution.
Well, it would. You have to. You need to clear through an authorized clearinghouse, and that is done in part to protect. The institution should make its own judgment about the creditworthiness of the clearinghouse, but it's done in part to protect. So if it's an unauthorized clearing, you can go anywhere from capital penalties or other penalties. So there's ways to do it. The question is the logic of it, and we would suggest that it just doesn't make sense for European car manufacturers, European pension funds, European banks, ultimately European individuals to pay tens and tens of billions of euros in extra costs for a service that is done properly in London, for which there can be a close supervisory cooperative arrangement, information sharing, and that works and is ultimately, I'll finish with this, which is consistent with the objectives of the G20 and the FSB, including all the European members of the G20 and FSB, to clear derivatives in this way, because that's one of the ways to learn the lessons of the last financial crisis, or address the issues of the last financial crisis.
So you're champing at the bit to get going?
We're certainly, yes, and I would say this as well. We are absolutely ready. We have worked this out to deep detail. Yeah.
Okay, thank you.
Thank you. I'm going to bring in Stuart.
Morning, Governor, and apologies for not being here for the end of this session. Sam Woods from the PRA has criticised the state of contingency planning among some EEA firms with branches in the UK. He said that we're having to push the inbounds that EEA and EU firms exercising passport rights to move on with their thinking. Do you believe they're responding to the calls to develop their planning? And can you shed any light on why firms supervised by the PRA, or of the firms supervised by the PRA, this group of inbound EEA and EU banks are the least well prepared for no deal?
Yeah. First, I obviously subscribe to the comments that Mr. Woods made. We work together on the PRC and closely on all these Brexit issues. And it's absolutely correct that there has been a difference in terms of the depth, level of sophistication and advancement of contingency planning of outbound firms versus inbound firms, which is why was one of the main reasons why Mr. Woods, wrote to all of the firms to get their contingency plans, and we're working more closely with the inbound ones. To some extent, it's a matter of speculation, but I would say, based on some conversations, there's been two assumptions. One has been that are of interest, let's put it that way. One has been that there has been some assumption by inbound firms that there would be some form of transition arrangement put in place, and therefore the urgency of this type of planning was less important, and perhaps an implicit assumption that they would be grandfathered effectively if they were operating as branches here previously under European passporting. I think they now understand that the latter isn't necessarily going to be the case, and we'll have more to say about that in due course. In terms of the presumption on transition, and I think it could go back a bit to Mr. Malthouse's questions around derivatives. I think it's interesting. There is some presumption on. I would observe that well, we are preparing, as we should, for the possibility of a hard exit, if I'm allowed to use that term, but a hard exit without a transition. Okay, I'll substitute that. But a hard exit without any transition period. So we're doing all those preparations for that. There has been much less of that done in the European Union, including by the member firms.
That's interesting. I would have assumed, just to digress, that transition for complex financial institutions would require to be over a considerable time frame.
Yeah.
So is your judgment that they're assuming this won't be a 1 year or 2 year, but this would be a prolonged transition, at least in their minds, given how long, for example, it's taken for Solvency II to be bottomed out? Is that, do you think that's the judgment in their minds?
I'd probably limit my the degree to which I try to interpret other people's thoughts. I think that it is, I'll state this in my opinion, it is absolutely in the interests of the EU 27 to have a transition agreement. And also in my judgment, given the scale and the complexity of these issues as they affect the EU 27, that there will ultimately be a transition agreement. There's a very limited amount of time between now and there's very limited amount of time as pertains to your question between now and the end of March 2019 to transition large, complex financial institutions and activities. And you referenced Solvency II. If one thinks about the implementation of Basel III, agreed back in 2011, implemented fully 2019. We have extensive experience, and I think we're alone in the current members of the EU having this experience. We have extensive experience, and expensive experience, I might say as well, of managing the transition for individual firms of various derivative and risk activities from one jurisdiction back into the UK. That tends to take 2 to 4 years. We're talking about, potentially, depending on the agreement, a substantial proportion of the activity in London. So I think common sense, familiarity with the issues dictates that transition agreement is in everyone's interest, and that's why we've been saying this from day one.
I wouldn't want to bring you into political debate at all, of course, Governor, but that sounds like a rallying call against a hard exit or a clean exit or any other sharp exit.
Well, I won't. Yeah, you've rightly alerted me to be careful, but it's in our. There's a question of what the ultimate arrangement is, but having a orderly move, and I'll quote the President of the European Council. A disorderly Brexit is in no one's interest.
That's fine.
So
let me move on from that bit of fun. The PRA expects, I think, around 130 applications for authorisation from those banks to do business. Some will be allowed to retain a simple branch operation. Others, however, would require to move to a subsidiary basis. What's the balance between the two, and what's the difference in complexity between continuing, say, to run a branch operation and be required to set up a subsidiary given the circumstances of the Brexit?
Yeah. Well, we have an existing branch policy, the PRA does. And one of the simplest things, there are a couple criteria that are relevant. First, if you're engaged in significant retail activity, we will tend to want you to be a subsidiary, to be appropriately capitalized liquidity. Secondly, if we have the degree of comfort we have in terms of the resolvability, to go to the other end of the spectrum, resolvability of the institution, so will it be an orderly resolution if something goes wrong, that will increase the prospects of that institution being a branch, as will the degree of information sharing, supervisory cooperation. I'd put it, if I could put it broadly, there's questions around how systemically important the activity is as one consideration. The other consideration being the degree of supervisory cooperation and information sharing. So if I map that to the subject at hand, the future relationship with the EU27, that second bucket, what's the future degree of supervisory cooperation, information sharing, the analogy of what Mr. Maltos was asking around central clearing, what's that going to look like? That will be determined, in my view, that will be determined as part of the ultimate trade and investment agreement with the EU27. So we need to know that. And I'll finish here, if I'm an inbound firm, I shouldn't presume necessarily what that is going to be, the best outcome there. I should have a contingency plan. In fact, I have to have a contingency plan because we've asked them for it, for a world where we don't have that agreement and they're a third country branch coming into the UK. Now, we don't want that outcome. We have, not surprised, very good relationships with the European authorities. We have full information sharing, good supervisory cooperation. We think that's in the best interest of the EU and the UK, but the question is how would that be structured in an agreement, and those discussions, as you know, haven't yet begun.
I'll come back to a little more of that, but just you said in the middle of that answer about potential risks or difficulties with resolution at the worst case scenario. Do you think, given any number of the potential outcomes, that we're going to have to revisit the primary legislation on resolution if we do end up with a number of substantial institutions operating simply as branches in the UK?
Well, no, I don't think you will need to revisit legislation. We, as the PRA, and what you would look to us is to determine if that is indeed the case, whether those institutions shouldn't be allowed to operate as branches.
Fine.
That's the follows. We have those powers.
In which case, it leads me on to the risk of disruption to wholesale banking as well, because EA firms branching into the UK lose their authorisation to do business, but these banks provide a tenth or thereabout of all lending to UK companies.
That's right.
So notwithstanding we don't want the branch scenario, we prefer the subsidiary model for the reasons you've given. Is there any immediate prudential reason why the PRA shouldn't allow these firms to continue doing business, or risk potentially the loss of tens of billions of
money? Well, that's the judgment. I think it would be an error to presume that we would authorize all those EU branches that are currently active here, because they're active here on a framework where we have close supervisory cooperation, we have information sharing, we have ultimate appeals to joint decision making through the EBA and other processes. I mean, those are to be used in extremis, but there is that deep arrangement that exists that underpins so-called passporting. And if we don't have any of that, then the systemicness of the branch becomes determines whether it can continue to be a branch or whether it would need to be a subsidiary. Again, for completeness, we think that if we may not have exactly what we have under the current arrangements, but we could develop something that's very close to that, which would provide a great deal of comfort and would have a much more seamless transition and keep that activity here.
Can I?
Sorry, yes, of course.
I was going to bring Roshnara in, actually, who I think...
Just one final adjunct to that then. Should an EU or EA bank have a branch here that services its customers, but it's a small part of their business, and they choose not to go down the difficult or time-consuming route of subsidiarisation, one could easily envisage, with no malice, a loss of capacity. I presume the bank are preparing to see how they can support the banks which are left, the subsidiaries which are left, to pick up the slack in that kind of circumstance.
Yeah, I think so that circumstance, and that circumstance goes both ways. Yeah, and so one of the things that's happening for a series of financial institutions that are resident here outbound into EU27 is their ultimate boards are looking at the economics of splitting the business or shifting the business, incurring the costs to move to the continent. And there will be cases, there are cases where they will shut down the business as opposed to shift it. The economics don't work. And that's unfortunate, and that's a net loss for everybody concerned. I would say a general point is it's less about us supporting the banks that remain. As a general thing, that in an uncooperative outcome, which everybody wants to avoid, but in an uncooperative outcome, at least initially, the UK will be long financial services, if I can put it that way. We will have more capacity, capital, individuals, collateral in the UK, and the EU will be short financial services because not all of that capacity will be able to go across, which is one of the reasons why the entire economic impacts are greater for the UK, but from a financial perspective and a financial stability in the short term, from a financial stability perspective, they're greater for the EU than for the UK.
I must apologise.
Okay, thank you.
Thank you. Just picking up on that point, Governor, do you think that the EU sees the legal vacuum facing cross-border contracts as a shared problem? Does it, there are lots of issues on our side, but is this a mutually, in your judgment, is this something that they see as equally important to them?
I think it's...
at this stage, the pound's showing that giving into US dollar strength, also the fact that, there's nothing here from Carney to support it. We'll continue watching just in case there's something which is hard hitting, but nothing here is really causing the selling. It's just the fact that Carney's not talking up rate hikes, he's talking up Brexit. It's all about Brexit, right? No deal, more pound selling. Get a deal, we get pound buying. Sharp pound buying. So that's the way you got to view it. It's a very, very, once again, binary scenario. You need to, what is driving the market, the pound, US dollar strength, and lack of Brexit deal is a potent combination. Optimism is good, but you still, you can go bankrupt before you get proved right. So you can either buy cheap, which would be lower, or you can wait for buying and get a worse price whenever we get a deal. At least you don't get caught.
Time it takes is the suggestion that the 2 years for a transition deal adequate to deal with some of these complexities? For instance, the estimate of some 20. The value of these notional contracts for derivatives being around 20 trillion pounds, for instance, is 2 years adequate?
Well, 26 trillion, I think, is the notional value of these derivatives. So the same ballpark, yeah. So is 2 years enough? Our view is that the first best way to address this issue would be through legislation which would give continuing permission for these contracts, effectively grandfather these contracts, but that requires legislation both in the European Parliament and in this Parliament.
How realistic is that?
Well, it requires an understanding of the issues. I think if it's understood, it's realistic. And this is your world, not mine, but what makes me nervous is that, legislative timetables are packed. Certainly here, but also in Europe, and you do need those. You do need it to come through, and you need it on both sides, because if we just authorize the UK and the EU aren't authorized, then the continuation can't happen. I think but I'll make a more general point away from just the derivative contracts. which is timetable for transition, so 2 years. Is that sufficient time? It's sufficient time, and one has to work with what you get, but it's sufficient time, particularly if we get what I would, if I'm allowed to use an adjective, a reasonable agreement on the end state. In other words, something that has a degree of supervisory cooperation, information sharing, which means that not all risk, capital, collateral individuals have to move. Because if you do the latter, if it's a very limited agreement in terms of cross-border flows and authorizations, then you have to be in a position as the EU authorities have to approve all the individuals, have to approve all the models. The collateral has to move. All these counterparty issues, not just for historic reasons. They're big economics that are determined by the history of where trades have been made, on top of all these other technical issues, and all of those would require to be done properly a longer period of time. Now, if there's an agreement that certain activities can continue to flow cross-border, then it's a reasonable period of time for the types of activities people are taking.
So, Governor, if the agreement isn't reasonable, what is going to be required to mitigate against consequences?
If there's not an agreement, what we have highlighted, as you know, 3 big areas as sort of cross-cutting issues: the derivative issue, which we've been discussing, cross-border provision of insurance. There are tens of millions of people in Europe who have insurance from the UK that the UK domiciled entities cannot pay out without authorization.
That's right.
So that the EU has to address that, and data protection issues and authorization for data to go, which is again an issue where, if I can put it this way, there's more data that's relevant to the EU in the UK than vice versa in this case. So this is kind of a consistent thing where it's not surprising, given the historic position of London and the UK as the financial service, an important financial service provider to the EU, that these issues are bigger for Europe than they are for us, although they're material for us.
In this case, we have much more leverage in order to be able to get a deal.
I mean, I wouldn't want to use financial stability issues. I mean, as leverage. I want them to be addressed in a sort of bloodless, technocratic way to the interests of all the citizens of both sides of the channel.
So you mentioned, we're talking about insurance. We're talking about what it will mean in terms of real lives, both in terms of insurance and banks.
Yeah, these are real issues. These are real issues.
So what would be the consequence of an unreasonable deal or no deal?
I think
on real lives.
What I was going to say,
if
there is not a deal, and we're into conjecture, but if there's not a deal, for these issues there needs to be legislative solutions to address, and some of it's secondary legislation as opposed to primary, but there need to be secondary legislation at a minimum that would, for example, authorize European holders of UK data that the standards continue to meet our standards. Now, it's reasonable to make that judgment because we implicitly make that judgment today. At least it's reasonable for a period of time. Parliament would decide what that period of time would be. So
Parliament could choose to set a longer time frame.
Parliament could,
as part of that legislative
Parliament
process.
could address with respect to UK residents, UK citizens, on insurance and on data. Parliament can't solve Europe's issues on those 2 issues, and Parliament, as we've been saying, can't unilaterally solve the derivative issue.
Sorry, just to pick up on Kit's point earlier, can you clarify whether there have been opportunities to speak with regulators, financial regulators in your counterparts outside of the Article 50 process on some of these really important issues?
I mean, the risks, yes. The solutions, no. Because solutions would be, well, it's not it's a responsibility of the governments and the negotiators for those solutions.
Right. And I just have one final question, which is, has the FPC considered the macroeconomic impact of a no-deal scenario and how that would affect financial stability?
You just slip that in at the end, just a little question.
And just answer yes or no, that would be fine, yes.
Yes.
Thank you. Yes, right. Catherine.
Thank you.
Thank you.
Thank you. Since the referendum, the MPC's economic forecast, which now extends to Q3 2020, is conditioned on the average of a range of possible outcomes for the UK's eventual trading relationship with the European Union, which you have already referred to this morning. But how has the probability of those range of possibilities, what is the current standing of those?
Yeah. Thank you for drawing attention to that. Yeah, it's been conditioned on two things. One is that range of possible outcomes, and we have not been we haven't been mark-to-marketing those probabilities. We've just taken an average of a range of outcomes from a WTO outcome to something approximating a full, comprehensive, ambitious trade agreement, which is the objective of the government. We have also assumed a smooth transition from where we are today to that outcome.
Okay. And so are you therefore working on a best case scenario, or are you working on an average scenario between the worst and the best?
The best case scenario would be to assume a smooth transition to full comprehensive trade agreement. So we're not assuming that. We assume that it's somewhere in the middle, and there's no, you're not going to be able to draw me on more than that, because we're not predicting a certain. Don't want to have us predicting a certain outcome of the negotiations, but we have an average of various scenarios. The consequence of that is that there are some impacts of the future agreement in the forecast. They're relatively modest, but they do weigh a bit on productivity and the path of supply or potential growth, different words for the same thing, over the forecast horizon. So it does matter, and if we were to have a full an agreement reach, that would have positive implications for our forecast. If we were to have a full, comprehensive, ambitious trade agreement reach, that would, all things being equal, that would have positive implications.
Okay, so as I understand it, you're not working on sort of multi-case scenarios, you're working on somewhere in the middle in terms of what the possible outcome might be. That perhaps is based on an assumption that is the most likely place where we arrive at.
It's a simplification. It's a simplification. It's a simplifying assumption.
Risk that we might end up with a scenario?
I mean, broadly, what I do when I trade a lot all the time is I look for trades I like I like long dollar yen, and I wait for impulsive candles. I like for support to be found, a decent pullback, and then a story which has legs, which is the new Fed chief, potentially being John Taylor, Fed raising rates, stocks very strong. So I like dollar yen higher. You might have to wait for Japanese elections to be over to get that break higher. Stock market selling will drag it lower. Taylor not winning will drag it lower. Some extraordinary ECB meeting, euro strength might drag it a little bit lower. But broadly speaking, the risks are pretty good here on the long side. And I like to have as many things in my favour as possible.
And if a transition agreement were reached and the horizon over which the new relationship was pushed off into the future as a consequence, that would be potentially material for the forecast. Or if, as you say, we end up closer to one end or the other end of that spectrum, that will also be material to the forecast. But what really matters in the end is what do businesses and households, what are they expecting, and how are they reacting? And in general, we will come on to that. Maybe we'll come on to that.
Yeah, well, I was going to ask about that, because I have to say I was expecting sort of a range of possibilities being looked at, only because there is a concern that therefore we'll be ill prepared for whenever comes.
We have looked at a range of possibilities, and to Ms. Ali's question, we have looked first and foremost at the Financial Policy Committee. We have looked at as you would expect us to, sort of worst case scenarios and what are the channels of risk that would come from those, which go above and beyond what we've been discussing, and what can we do now to mitigate those risks. And in a slightly different tack than on monetary policy, in response to Mr. Jack's question, where I said it didn't make sense to build up the war chest in advance with interest rates just so you could cut them in the future. From a capital perspective, from a liquidity perspective, from a preparedness of the financial system, it does make sense on the margin to make sure that they are robustly capped. In fact, you would expect us this to be the case, that these institutions are robustly capitalized, including for a very bad outcome, at least a very bad outcome in the short term.
Okay. Yeah, I mean, because the Chancellor told the committee last week that there is cross-departmental modelling being used by the government to assess the impact of different Brexit outcomes on different sectors of the economy and different regions. Does the MPC have access to this data?
We have. I apologize. I don't know exactly to what he was referring. We have regular discussions with certainly the Treasury, but also DEX-EU regarding sectoral impacts. Ultimately, what we our concern is the aggregate impact, and we have our own modeling of scenarios and adequate impacts, but they're not scenarios that they're for internal analytics, if you will, as opposed to public.
So do you, by your own assessments, do you have concerns about there being particular impacts on particular sectors or particular regions of the UK?
Well, if I go to our remits, and back to where the chair started this discussion today, we don't target regions, we don't target specific sectors. So if we're looking at a sector, whether it's, say, the auto sector, the agricultural sector, sectors concentrated in the north, steel, for example, we look at it to see about the multiplier impacts through the economy, as opposed to any targeted intervention to those sectors.
Okay. So another Brexit-related judgment in the MPC's post-referendum forecast is that households and companies base their decisions on the expectation of smooth adjustment to a new trading relationship, which you've already referred to. Have those expectations to that smooth arrangement changed? What's the current status in terms of your consumer engagement?
In terms of consumer engagement, I would say in terms of businesses, there has been an evolution of those expectations, in that they have businesses have become less confident about a smooth transition and less confident about the ultimate end state, the degree of access, but less confident, not lacking confidence, so I'll put it that way. In terms of households, the households have been more affected by the path of real income growth. Consumer confidence.
All right, guys. Yeah, broadly speaking, that's a lot. That's a lot of Carney. I think you've seen the market's reaction, looking for some sort of bullish reaction. Didn't get that. You've seen the breakdown now. You push through. You might see a little bit more selling coming through. Probably the majority of the move is done. Let's see what the US dollar does today, rather than try to push that the pound's going to fall by itself. The pound can, but you know, I mean, the sort of the easy money part of that trade is done. The next little bit is the support zone. If we break below 132, 131.20, then tomorrow's will be much more interesting for the pound. But yeah, there's still bargain hunters out there, right, who want to buy and expect a deal, myself included. And eventually, if you get support coming through, you'll probably get a retracement here. There's nothing, there's no hard hitting headline there that's ultra negative. It's just there wasn't any support coming from his speech, and CPI was as expected, and the market still went down. So we're looking now for stops more than anything else. But a Brexit deal, if it comes through, is huge. It's 500 points big. So that's really the top side argument. In terms of why we're long dollar yen because of risk reward and the new US dollar strength coming through. It's not a popular trade. It's at like right now, but you know, like positionally wise, there's heavy shorts in the yen. That's true, but I still like the fact that it can push high here, sort of under the radar as well. And the only thing that's really dangerous to it is North Korea, you know, doing something crazy, or dollar, you know, stocks starting to fall for the first time. But other than that, the weakness in the euro is pretty systemic, and you know, US dollars catching a bit on the John Taylor rumors. So tomorrow, what we're going to do is have a special preview of the Black Monday, right? Black Monday is 30 years ago on Thursday. So we'll go through this little article, have a look at some of the comments from some of the members. Interesting article. So if yeah, tomorrow we're going to go through what happened Black Monday, because that's such a big event in financial history, and the 30-year anniversary is on Thursday. So let's see eventually if stocks, because everyone's like drawing parallels now to the ridiculousness of the US stocks to what was happening in the 80s. Perhaps we will see the first crash in a long time at some point. Alright, trade safe, guys. Look out for what happens in stocks, but other than that, there's not too much to be worried about here. Just broad US dollar strength on Fed chief changes.